Hello everyone, welcome back to my channel Risk Modeling Hub. I have started 100 Days of ECL Mastery series. If you haven't watched the day 1 video yet, click the link in the I button or I'll mention in the description and please watch it. And today I'm excited to bring you the second video in our 100-part series on expected credit loss models. And today we are answering a fundamental question that every credit risk professional should understand. Why do banks actually use ECL models? And more importantly, what are the regulatory requirements behind IFRS 9 and Basel III that make these models essential? Now, if you watch our first video, you know we talked about the foundational concepts and fundamental things about the credit risk. But if you didn't, don't worry. We'll build the context as we go. And today's discussion will give you deep insight into the regulatory landscape and the practical reasons why ECL models have become non-negotiable for modern banking institutions. By the end of this video, you will have a comprehensive understanding that will definitely help you ace the credit risk questions in the interview. So let's get started. Let me set the context for you. Before 2018, banks operated under what we called an incurred loss model for accounting purposes. Think of this as a reactive approach. Banks only recognized losses after that actually happened. And if a borrower defaulted, that's when the bank recorded the loss. If a borrower showed early warning signals but hadn't defaulted yet, nothing was recorded on the balance sheet. So this approach had a massive flaw, and the 2008 financial crisis exposed it dramatically. During that crisis, banks were shocked by sudden massive credit losses because they hadn't been provisionally adequate. Why? Because the incurred loss model forced them to wait until the damage was already done. It was like installing smoke detectors after your house had already caught the fire. So regulators and accounting standards setters they learned a critical lesson. The financial system need a more forward-looking approach to credit risk. In response, the International Accounting Standards Board or IASB introduced IFRS 9 in 2018. In the United States, they developed ASC 326, which is essentially their version of the same concept, calling it CECL, Current Expected Credit Loss. And regulatory capital frameworks like Basel III started aligning with these accounting standards. The shift was seismic. Instead of waiting for defaults to happen, banks now had to estimate potential losses upfront based on current economic conditions and the forward looking information. And this is the expected credit loss model. And it fundamentally changed how banks think about and report the credit risk. Now let's dive into how IFRS 9 ECL framework actually works because understanding the mechanics will help you understand why banks need it. IFRS 9 gives the bank three different approaches depending upon the nature of the financial asset they are measuring. Most retail and corporate loans fall under it, the General Measurement Model or the GMM. Under this approach, banks must classify every loan into one of the three stages based on whether there has been a significant increase in credit risk since the loan was originated. So, stage 1 applies when a loan is first originated or when it hasn't experienced a significant increase in credit risk. For these loans, banks recognize a 12-month expected credit loss, essentially the loss expected if a default occurs within the next 12 months. And this is forward looking but still relatively conservative since it is limited to 1 year. Stage 2 kicks in when there is a significant increase in credit risk, but the loan hasn't defaulted yet. Think of as a borrower whose credit score has dropped significantly or a company that's showing the financial distress. So for stage 2 loans, banks recognize a lifetime ECL, the loss that would be expected if the borrower defaults at any point of time during the remaining life of the loan. And this is crucial because it captures the deterioration before default actually occurs. So the question comes up, what is SICR? SICR, this is the assessment, which is critical bridge between the stage 1 and stage 2. Banks use quantitative metrics combined with qualitative factors to identify when credit risk has increased significantly, triggering the shift from 12-month to lifetime ECL provisioning. And it must be assessed continuously at each reporting date. There are both quantitative and qualitative factors to determine the SICR. Like you can do the PD comparison between the origination date and the reporting date. You can determine rating migration as well to assess the upgrades or the downgrades. You can also assess borrower specific issues if any unexpected management changes happen or if there is any previous restructuring history. There can be many other factors as well to determine this. One should follow the SICR assessment process as mentioned below. First, you need to gather the quantitative metrics like ratings, PDs for that particular borrower, and assess the qualitative indicators like industry scenario or if any previous restructuring has happened or any other factors as well, as mentioned in the qualitative SICR indicator on the right side. You need to then compare the metrics against the defined SICR thresholds and make the final stage 1 or stage 2 classification decision. Then you need to validate the decision and document the internal reasoning and then recalculate the ECL provisions. Stage 3 applies to the loans that are already in default or credit impaired. These also require the lifetime ECL recognition, which is the highest provisions one. But the underlying calculations are quite different since we are dealing with actual default situations and historical recovery data. The brilliance of this three-stage framework, the three stage 3 and stage 1 to stage 2 and 3, the framework is that it forces the banks to continuously monitor credit risk migration. A loan doesn't just sit in stage 1 indefinitely. It moves through stages based on actual changes in the borrower credit worthiness. And this creates a dynamic provisioning model that reflects the real credit risk conditions. Now let's understand how are these ECLs actually calculated. The most common methodology and the one that you will see in the banks globally and certainly in your interview questions is based on these three components, which are core components: probability of default or PD, loss given default or LGD, and the exposure at default or EAD. The formula is very simple that you have seen. Along with that, there is a discounting factor D attached, which typically represents the effective interest rate. Now let me break down what each component means. PD, the probability of default. It is the likelihood that a borrower will default on their obligations during a specific time period. Banks use point-in-time PD for ECL purpose. And this means the PD reflects the current economic conditions and the borrower's present financial health and not some average across the economic cycle. Loss given default. It represents how much a bank will lose if a default occurs. And this isn't the 100% even in default scenarios because banks often recover something through collateral sales, unsecured recoveries, or other workout mechanisms. LGD varies based on portfolio type, collateral type, and its seniority as well. Exposure at default, EAD. It is the total amount at risk when a default occurs. This includes not just the principal outstanding but also the accrued interest and future interest that the bank expected to receive. For stage 2 and stage 3 loans, this requires banks to model the entire remaining lifetime of the facility, accounting for expected repayments, potential prepayments or drawdowns on the committed facilities. Discounted rate. It is done to discount the future losses to present the value, and this reflects the time until the expected loss occurs. And here's where the regulatory capital comes into the play, and this is critical for your understanding. Basel III isn't just an accounting standard like IFRS 9, it's a capital adequacy framework. It defines how much capital banks must hold to absorb the potential losses. The Basel Committee on Banking Supervision issued formal guidance on credit risk and expected losses, recognizing that the move to ECL accounting strengthened the entire financial system. Basel III capital requirements talks about three pillars. Pillar first, minimum capital. Pillar second, supervisory review. And third pillar talks about the market discipline. And here's the key insight. Basel III capital requirements incorporate the same underlying credit risk components that we just discussed, PD, LGD, and EAD. But why this matter? Because it creates the consistency. Banks aren't calculating the credit risk one way for accounting purposes under IFRS 9 and a completely different way for regulatory capital under the Basel III. The frameworks complement each other. Both use forward-looking credit risk assessments. Both require banks to continuously monitor and update their risk parameters. Both demand that banks have sophisticated data, models, and governance frameworks to support their calculation. However, and this is important, there are differences in application. IFRS 9 focuses on financial reporting accuracy and determining the right level of provisions on the balance sheet, whereas Basel III focuses on ensuring banks have sufficient capital to absorb unexpected losses across various stress scenarios. And this is why banks can't just build one model and can be done. They need comprehensive risk frameworks that feed into both the accounting and regulatory calculations, but with the understanding that the emphasizes and the time horizons these might differ. Now let's talk about the practical business oriented reasons why banks actively implement ECL models beyond just the regulatory compliance. First is the pricing and the profitability part. Under the old incurred loss model, banks didn't feel the cost of credit losses immediately. But under ECL, these provisions they hit P&L from day one, forcing accurate risk-based pricing. Second is the risk management discipline. ECL models require banks to have comprehensive data on the historical defaults and these recoveries, economic conditions, and forward-looking information as well. And building these data sets, keeping them current, creates enormous discipline. And banks need to track migration through stages, validate their models, and ensure the data quality. Third is the early warning systems and the regulatory compliance, regulatory capital alignment. Now, the SICR framework, the significant increase in credit risk framework, it forces banks to identify the deteriorating borrowers before the default. And stage 2 classification requires lifetime provisions, which creates both a financial incentive and a management signal to address the problem early. A bank might intervene with a struggling borrower to restructure the loan or increase monitoring precisely because moving to stage 2 carries the financial consequences as well. Next is the stakeholder confidence, most important point. When banks transparently disclose the ECL provisions and the methodology behind them, it builds confidence with investors, regulators, and depositors. Investors can see that the management has identified and measured credit risk appropriately. Regulators can verify that banks aren't under provisioning, and this transparency actually supports bank stability, particularly during stress periods when investors are worried about the hidden credit loss. So, before we wrap up, let me give you a bit of additional depth on the core model components that we talked about. And you will definitely encounter the detailed questions about them in your interviews. So, for probability of default modeling, banks have multiple methodologies. Some might use scorecards or rating developed internally. Others use sophisticated machine learning models or hazard models. And the key requirement is that PD must be point in time, which should reflect the current economic conditions. These banks might develop first the through the cycle PD, TTC PD, based on longer term of historical data. And then they apply macroeconomic overlays to convert it into point in time PD. And this is important because it captures both the fundamental credit worthiness of the borrower and the current state of the economy. For loss given default, banks need to think about recovery dynamics. Some use static historic averages, On average, that like we recover 60% of the exposure, but more sophisticated approaches recognize that LGD varies by stage, by collateral type, collateral values, and by the macroeconomic environment as well. In a downturn, collateral values they fall and recoveries take longer. So LGD should increase. And this creates what we call LGD term structure. Different LGD values at different points in time based on expected recovery dynamics. So we'll consider LGD term structure as well in our upcoming series. For exposure at default, and this is where the modeling becomes quite complex, EAD must account for contractual amortization of the loan, expected prepayments, and for revolving facilities, expected utilization of a available credit. A borrower who prepays a loan faster than expected actually reduces the EAD, and this will eventually reduce your ECL. And that is why the understanding the borrower behavior is crucially important for EAD modeling. Now, banks also need to incorporate the macroeconomic variable overlays as well, forward-looking adjustments based on economic forecast. IFRS 9 explicitly requires the ECL that will reflect not just historical information and current conditions, but also reasonable expectations about future economic conditions. So, a bank should be modeling ECL under the baseline, upside or downside scenarios, and then weigh them by the probability to arrive at a weighted ECL. Very important point. And when recession looks likely, the bank's weighted ACL should increase because PD assumptions increase, and there we becomes the conservative. Finally, banks also apply post-model adjustments as well, commonly known as PMAs or overlays, when models don't fully capture the emerging risk. And during COVID-19, for example, some industries weren't adequately capturing by the historical models. So banks applied the overlays. And these adjustments need rigorous governance because they are subjective, and auditors and regulators scrutinize them, they watch them very closely. So let me give you a concrete example of how the three-stage ECL model works in practice, and because this will anchor your understanding as well. So imagine a bank originates a 100,000 amount of corporate loan. At origination, this borrower has strong fundamentals and an investment good rating, and the bank estimates a 2% of the annual probability with 35% of LGD. The banks classifies this as stage 1 because there is no SICR till the time. For a 5-year loan, the 12-month ECL might be around the 700 point, a relatively modest provision. Now let us fast forward this to 18 months after. The borrower in the industry now is facing challenges. Their revenue growth has slowed, and the bank's internal rating model has also downgraded them by 2 notches. The estimated lifetime PD has now increased to 8%, and the loan hasn't defaulted and isn't in arrears. But clearly, the credit risk has significantly increased, and now the bank moves this loan to stage 2. Now, the bank must provision for lifetime ECL on the remaining 3.5 years of the loan with an estimate of 8% of PD and 35% of LGD. Depending on the remaining exposure and discount rate, in this case, the lifetime ECL might be coming around 8,000 to 10,000. It's a dramatic increase. The point is that the idea is that I want to you understand that as the loan moves from stage 1 to stage 2, there is a huge difference, I would say a huge jump when it comes to provisions between the stages. Now finally, if the situation worsens and the borrower misses the payment or is officially classified as in default, the loan moves to stage 3. Now the bank recognizes the lifetime ECL based on actual default circumstances and historical recovery patterns. The bank might move to work out the management, initiating the legal proceedings or negotiating a restructuring. And this flow through stages isn't deterministic. Loans can move backward too. It's not just like the stage 1 to 3. No, it can be from 2 to 1 as well. Now, this creates a right economic incentives for banks to manage and improve the credit quality. Now, something that distinguishes the strong banks from weak banks, it's the independent model validation. IFRS 9 and Basel III both emphasize that Banks need robust governance around their ECL models. Banks should have a three line of defense framework. The first line of defense is the model developer, the team that builds the PD, LGD, and EAD models. The second line is an independent model validation team. These validators aren't involved in model development. Their job is to comprehensively review the entire model development process and challenge the assumptions. A good validator will assess data quality across all the stages of extraction, transformation, and feature engineering. They'll evaluate whether the chosen methodology is appropriate for a specific portfolio. They will test whether the model output aligns with the observed outcomes through backtesting and sensitivity analysis. They will identify all the subjective assumptions and evaluate whether controls around those assumptions are adequate. They will review the documentation to ensure it's detailed enough for an independent reader to understand and potentially replicate the model. The third line is the internal audit, which reviews both the developers and the validators framework to ensure the compliance with the policies and the regulatory requirements. And why does this matter? This is because ECL provisions are material to financial statements and directly impact the regulatory capital ratios. If a bank's PD models are wrong and overstated, the bank's provision might be excessive and making the true financial situation. If they are understated, the bank is under reserved and risk the capital inadequacy. Regulators focus heavily on ECL model governance, and audit findings in this area are taken very seriously. These audit findings they need to be taken very seriously because the banks that have weak validation frameworks, they face regulatory criticisms as well, and that too very frequent. Now, based on the observations from leading financial institutions implementing the ECL frameworks, there are several common challenges that you should be aware of, and these also make good interview discussion points. Data quality, which is the biggest challenge. Many banks, especially those with the legacy systems, struggle with data completeness and accuracy. They might not have clean historical default data, or they might have defaults recorded inconsistently across systems. Building a unified borrower view across different banking applications is surprisingly difficult when systems weren't designed with ECL modeling in mind. This forces many banks to build significant data infrastructure before they can even start modeling. Model methodology selection. This requires careful thought. Different portfolio segments might require different approaches. A retail auto loan portfolio might use a simple row relate method with behavioral scorecards. A large corporate portfolio might require hazard models or machine learning approaches. There's no one size fits all, and selecting the wrong methodology for a portfolio is a recipe for model failure and regulatory issues. System capability, which often lags the requirement. Many banks initially try to run ECL calculations in spreadsheets, which doesn't scale when you are calculating the ECL for hundreds or thousands of loans every quarter. Banks eventually invested in dedicated ECL systems, either commercially available platforms or custom built systems using technologies like Python, R, or SAS. Government and control design is complex. There are touch points across underwriting, risk management, finance, and IT. Turnaround times need to be managed because financial statement reporting deadlines are fixed. Management overrides need to be tracked and approved. And all of this requires thoughtfully designed controls and clear role definitions. Macroeconomic overlay frameworks, they require judgment. Banks need to decide which economic variables matter for different portfolios and how to weight different economic scenarios and how to update these assumptions as the new information arrives. This is more art than science, and banks struggle to explain and defend their choices to auditors and regulators. Now, understanding ECL impact across the organization will strengthen your interview readiness because it shows the holistic thinking. Pricing decisions, they have fundamentally shifted. Banks now recognize that a loan originating 3% of interest income that has 2%, let's say, of annual expected loss doesn't generate the adequate return. And this has driven a shift towards the risk adjusted pricing and risk based pricing models, where different customer segments pay different rates based on the credit risk. Capital planning and liquidity management. Now, these are affected because provisions reduce profits, which reduces the retained earnings and available capital. Stress testing frameworks now incorporate ECL sensitivities. Banks model how ECL provisions would change under severe recession scenarios, further economic stress, or industry downturns. Portfolio management. This has become more sophisticated. With granular ECL data by segment, customer, and stage, banks can identify which portfolios are generally appropriate with the risk adjusted returns and which are destroying the value. Accounting systems and the financial reporting. They carry far greater complexity because provisions change every quarter, and drivers of those changes need to be clearly disclosed and explained to the investors. Now, for decades, financial institutions used a one size fit approach to all for the pricing. They applied a single flat interest rate to all the customers, regardless of their credit worthiness. But this model has the critical flaw. Now, look at the old world math. A 3% of interest income minus the 2% of expected loss will give you a 1% of the net margin. The result is that the inadequate returns that does not properly compensate for risk. But now let's enter the risk based pricing. And instead of treating all the customers the same, institutions now price dynamically based on three factors: credit risk, cost to serve, and capital usage. Now, here the impact is that prime customers might see a 4% of rate. Near prime customers have 6%, and subprime customers do face this 12%, and each adjusted for their actual risk profile. And this isn't just about higher rates. It creates transparent economies, improves the adverse selection defenses, and stable portfolio returns. The pricing revolution has arrived, and it fundamentally changes how financial institutions approach the profitability. So, to circle back to the original question, why do banks use ECL? The short answer is that the regulators require it. IFRS 9 is now the global accounting standard. Basel III expects capital frameworks to align with ECL thinking, and supervisors enforce these requirements through examinations and enforcement actions. But the deeper answer is that ECL models represent a genuine improvement in how the financial system identifies, measures, and manages the credit risk. They force banks to think forward looking rather than reactive. They create incentives for risk based pricing. They enable early intervention in deteriorating the credits. They build discipline through data requirements and validation frameworks. And they create transparency that ultimately strengthen the financial stability. And please, for your interview preparation, remember that ECL isn't just a compliance checkbox. It's a comprehensive framework for understanding the credit risk and understanding the why behind the ECL. The regulatory imperatives and the business logic will allow you to discuss the credit risk intelligently and demonstrate the deep expertise. In our next video, I'll deep down into specifically into the probability of default modeling. We'll explore the different methodologies, data requirements, and validation approaches. And that's where the real modeling begins. So, if you found this valuable, please like, subscribe, and let me know in the comments if you have any questions about any aspects of ECL framework. And if you are preparing for a credit risk role, mark this content as a resource. So, thanks for watching Risk Modeling Hub, and I'll see you in the next video.